Good
Good
afternoon,
afternoon
everyone.
to all the listeners, and welcome to podcast with Peter Lewis. I'm Saf, accompanied by Vikram Shakti from Bullsmart, and we have with us Mr. Peter Lewis, who is a renowned orator, and he talks about business, finances, economics, trades, and political issues specifically related to the Asia Pacific region and the Asian emerging markets. He is a former investment bank global head of equities trading with over 40 years of experience of financial markets. Today, we'll be talking with Mr. Peter Lewis about investment tips in this episode called Good Investment Guide. So, Peter, how would you like to start the podcast on Good Investment Guide?
Okay, well, thank you for the introduction. Let me just add a little bit more colour to that. I've been working now in financial markets for almost 40 years. I started working in the City of London, which is the UK's financial centre, back in 1984. Seems a long time ago now when I say that. And I've managed
That's
businesses
nice.
and companies here in Hong Kong, in China, in Taiwan, Japan, Singapore, Australia, also India as well, and in the UK and France and Europe and the USA. For 8 years until the beginning of this year, I was the host of Hong Kong's top-rated business and finance radio program, Money Talk, which was on RTHK, and I now do that program as a daily podcast. So if you want to find that program, have a look at peterlewismoneytalk.substack.com. Now, in that 40 years, I've been an investor myself, like you are. I've run investment funds, and I've also been in charge of large trading desks at some global investment banks. So what I hope to do in this series of podcasts over the coming weeks is share some of the lessons I've learnt from those 40 years in financial markets. And I can assure you in that time, I've made every mistake in investment and trading that it's possible to make. So what I would like to do is maybe give you some tips or to first of all share with you some of those mistakes and what I've learnt from them, and then also give you some tips on how to make good investment decisions. And the good habits that you learn from investments and also from trading are actually good habits to learn in life overall. And there's a connection between the two. If you can make good habits in your life, you'll make good habits in investment as well, and vice versa. And making better decisions in investing have also helped me make better decisions in almost every aspect of my life. So good decision making is essential for good investment, and learning from your mistakes is also a key element of being a good investor and helping you avoid making bad decisions in the future. So what I'm going to do in these podcasts is try and give you an approach to investing that will help you build wealth over the long term, while at the same time managing risk and coming up with a risk profile that meets your personal financial situation. So I'm going to explain these principles, and I hope they'll help you as much as they've helped me. Now, this podcast is called the Good Investment Guide, but we need to step back and start with the absolute basics. Where is your investment going to come from? Well, investment is linked to your savings. Before you can invest, you need to save something to invest, and savings in turn is linked to your income. So unless you're lucky and you've inherited a pot of money, or you're given money on a regular basis by your parents or other family members, your savings are going to basically come from your income minus your expenses. In other words, what is left after you've spent most of it? Now, Warren Buffett, who I'm sure you've heard of, who is one of the greatest investors in the world, said that providing you save a little bit more than what you spend, you'll do okay over the long run. But that's easier said than done, isn't it? So the first thing you need to do is you need to maximize your income. Are you being paid what you're worth, or for what your contribution is to your company? If you're self-employed, how are you maximizing your potential? Now, I know you'll say I have no choice in that. My company pays me what it wants, and I have no choice in the matter. Now, that's not strictly true. There are ways in which you can learn how to negotiate well over your salary and remuneration and your bonus. And in some future podcasts, I'll give you some tips about how to evaluate a true worth for your skills and how to be a good negotiator with your employer. But for now, let's assume your income is what it is. So let's look at your finances. Are you spending less than you earn? Now, if you are, that's great. But if you're not, and many people are not, then you need to make some decisions. You need to cut your expenses, look at how much of your expenses are really essential, probably not all of it. And the key is to get your expenses below your income, because if you don't, you're going to, first of all, get further and further into debt. And secondly, you won't actually have anything to invest in the first place. So that's why I raised this issue about looking carefully at your finances, looking carefully at your savings, controlling your expenses. That is the first rule of investing, because if you don't do that, you're going to have nothing to invest. So how do you control your expenditure? Now, the first thing to do is to know how much you're spending each month. And it's be surprising how many people don't know or don't really understand how much they're spending and where their expenditure is going each month. So what I recommend anyone to do who wants to be a serious investor and wants to be a successful investor is, first of all, save all your receipts, put them into a spreadsheet, categorize them. What are they? Are they rent? Are they food? Are they going out? But begin by listing your expenses in a spreadsheet. Start with your fixed expenses. These are regular monthly bills such as rent, mortgage, utilities, car payments, and so on. Then list your variable expenses that change from month to month, but nevertheless, you have to spend on things like groceries, gas, and that's an area where you may find opportunities to cut back. And look at your credit card and bank statements, because they're often a good place to start, because they often itemize or categorize your monthly expenditures. But you must record your daily expenses. You must know how much you spend. Then the next step is create a budget. Before you make any investing decision, sit down, take an honest look at your entire financial situation, especially if you've never made a financial plan before, because the risk from investing has to be tailored to your particular personal financial situation. So you need to know what that is. And the foundation of any effective budget is your net income. In other words, that's your take-home pay after all the deductions that are made for things like taxes. Maybe you've got an employee retirement plan or health insurance. If you're self-employed, you need to make sure that you take into account that you're going to have to pay tax. But if you only think of your total salary, not your net income, it's going to lead you to overspending, because you will think you have more available money than you do. So if you are a freelancer or self-employed, make sure you keep some detailed notes of your contracts and pay to help manage irregular income. And this is where everything comes together, what you're actually spending versus what you want to spend. So you use the variable and fixed expenses you compile to get a sense of what you're going to spend in the coming months, then compare that to your net income and priorities. Consider maybe setting some specific and realistic spending limits for each category of expenses. And maybe you want to break them down even further into like things that you absolutely need to have and things that you want to have. For instance, if you drive to work every day, then petrol counts as a need. You must have it. However, if you want a monthly music subscription, that's not a necessity. It's a want, but it's not a necessity. The difference becomes important when you're looking at ways to redirect money towards your financial goals. So you've documented your income and expenses. You've made a budget. You can make adjustments as you go along, and make sure that you don't overspend, and try and put money towards your goals. And if you have to make some cuts, look at some of those things where it's your wants rather than your needs. Can you skip a movie night in favor of a movie at home? Or take a closer look at spending on monthly payments. Maybe some things that you need are just actually things that are rather hard to part with, but you don't really need. And if it still doesn't add up, then you have to look at your fixed expenses. For instance, could you save more by shopping around for a better rate on car or home insurance? They all come with big trade-offs, these decisions, but you need to think about these things. And even small savings can add up to a lot of money over time. And that is money that can be saved and redirected into investing and achieving some of your long-term goals. So you make a budget. Everyone who wants to be a successful investor has to have a budget. Review it regularly, because you're spending will change, and you need to make sure that you stay on track. Your income will change as well. You might get a rise, your expenses might go up, or you might reach a goal and want to plan for a new one. But whatever the reason, get into the habit of regularly checking in with your budget, following those steps I've just given you. Now, having done all of that, and they are the basic things you must do before you start investing to be a successful investor. You've done all of that. Are you now ready to invest? Well, actually, no, you're not, because there's two more things I'm going to ask you to do before you become an investor. The first thing is maintain an emergency fund. Create one, maintain an emergency fund. This emergency fund is to cover unexpected things, maybe a health emergency, maybe sudden unemployment, but you should make sure that you have ideally up to about 6 months of your income in savings, so that you know that if something went wrong, that is your fund that you can call upon to make sure you can carry on living and surviving in the meantime. It's not a fund that you touch until you absolutely need it. So that's the first thing I will ask you to do before you take the next step towards investing. Make sure that you're starting and building up this emergency fund. Now, the second thing I'm going to ask you to do is what I think is the best investment strategy of all time. There is no better investment strategy than this anywhere else in the world that pays off as well as this tip I'm going to give you, and will pay off with less risk than any other investment strategy in the world. And that is pay off your high interest credit card debt. Credit card debt is the most expensive form of debt you can possibly have, and paying off your high interest credit card debt as you can, if you owe money on it, is to pay off the balance in full and as quickly as possible, because that will earn you more money longer term than almost any other investment strategy that you can think of, particularly if your credit card, as most people's are charging about 30% per annum interest. You'll find it very hard to find any investment strategy that's going to meet that. So you've done these things, you've created your budget, you've tabulated your savings, you're looking at your creating an emergency fund, you're looking at what credit card debt you have, if any, and how to try and pay that up. You're now looking at thinking about how you should invest. So the first question you're probably going to ask is, how much should you invest? And even if you don't have very much money, the truth is you don't have to wait until you have hundreds of thousands of dollars in the bank to start investing. Investing works, whatever your demographics, whatever your tax bracket is, whatever age you are. And what you should start doing is be determined by how much you can start investing by taking a look at your particular financial situation and then work out an investment strategy that works for you and your budget. Now, what I would suggest as a general rule, is that maybe you can invest somewhere around 10 to 20% of your after-tax income. Now, it may be that you can't afford that, in which case you have to start smaller and work your way up to that goal. But the most important thing is to actually start. It's not the amount of money that you invest that counts. It's the time that you invest it for that matters the most. So even if you invest just a small amount of money, if you start early in life, that is going to start accumulating. And now some budget strategies do what's known as the 50-30-20 strategy. It breaks your monthly budget into 3 categories: what you need, which is about 50% of your budget, what you would like to have, which is about 30%, and then the other 20% goes into debt repayment, savings, and investments. Now, even if you can't afford the 10%, that doesn't mean you shouldn't invest altogether, because I'm going to explain in a future podcast why it's important to start investing as young as you possibly can, even if it's just a very small amount each month. As I said, investing is less about how much you're investing and much more about how much time your investment has to compound or appreciate in value. And that's because of what's known as the miracle of compound interest. Albert Einstein, that very well-known scientist, theory of relativity, he called compound interest the eighth wonder of the world. And it is, because it's that compound interest that will turn a small amount of savings and investment into a much larger amount. And I will talk about that a lot more in a later podcast. So where do you invest? You've decided how much. You're starting to build up the savings that you can make some investments, whether it be 10%, a bit less, a bit more. Where are you going to steer these savings into the right direction? Now, obviously, if you're younger, you can go into riskier assets, stocks and shares. And if you're older, you need to be moving more into safer assets, things like bonds, for example. But often it's going to be a mix of those things, and it depends upon your individual risk tolerance, which is another aspect of investing that we're going to talk about over the coming weeks. But somebody who's young and working should be almost all in stocks. Somebody who's near retirement age should be having a much bigger allocation to bonds. Now, there's one other area that I just want to mention, and again, I'm not going to dwell on this too much today, but we will talk about it in the future. What about trading? Now, I know that some of you will be wanting to trade. So if you want to do that, put a maximum amount of 10% of this money that you're going to invest into a trading fund. And you can do whatever you like with it, with that trading fund. Buy Bitcoin if you want, put your favorite stock in it. But bear in mind that this is a trading fund and it's different from your investments. Your investment strategy is for long-term appreciation. Your trading fund is because you believe you're a good trader and you're better than other fund managers out there and you can beat the market and make a lot of money very quickly. Maybe you can, maybe you can't, but I'm not going to try and stop you from doing it because it's pointless. I know you're going to do it anyway. But what I will do in a future podcast is to give you some tips on how to be a good trader, which is different from being a good investor. But for now, let's focus on the investment side. If you're just starting to invest, what is a good strategy to do? Well, maybe a good place to start is to look at mutual funds or exchange traded funds. These are collections of stocks, bonds, and other vehicles, rather than trying to invest in individual stocks, because then it will be easier to create a more diversified account using funds, particularly if you're starting off small. You don't have enough money maybe to invest in enough stocks, but you can certainly buy a small mutual fund, a slice of a mutual fund, or a small slice of an exchange traded fund, and let the fund manager do the work for you as you start building up experience. But one of the most important rules of investing is diversification. And diversification is important because it lessens the chance that your whole portfolio is going to lose value in a market downturn. You can find some funds with some solid track records. Look very closely at the fees, because fees are very, very important. They can take a big chunk out of your performance if the fees are too high. But there's many sites around, Yahoo Finance, Morningstar, that will provide research on funds, provide information on the fees. And diversifying across your entire investments or your portfolio, in other words, all of the investments you hold, is critical to building up your wealth, because it allows you to manage the risk much more effectively. So in your investment fund, which is 90% of what you have, we're ignoring for the moment that 10% that you've just got and put into your trading fund, your investment fund is absolutely critical to be diversified. So stocks are obviously one of the most talked about investments, but you don't want to tie your entire financial future to the success of a single company, or maybe not even to the success of a single market. So depending upon your financial circumstances and risk tolerance, you might be able to invest in other things as well: venture capital, precious metals, commodities, real estate. They're all available on the market, and all these investments can be effective means to achieve portfolio diversification and manage risk. And why is that? Well, that's because they rely on different underlying drivers. Each of those asset classes operates in ways that are normally uncorrelated with each other. I say normally, that doesn't necessarily already work, but in general, they have different things that make them move. So they may be going up and down at different times, which will help you achieve a balanced and well-constructed portfolio. So a good portfolio of investment includes several different types of assets, whether it be stocks, bonds, and other things that don't move in tandem. And this reduces what we call the volatility of a portfolio, but doesn't necessarily lower its return. Because you're diversified doesn't mean that you're going to make less money. What it does do is it reduces the volatility or risk of a portfolio. So these steps that I've told you just now are not going to guarantee you complete financial independence, but they are a very good starting point. They can help you build up your savings, achieve portfolio diversification, and then start to empower you to build wealth for a better financial future. Now, once you are ready to, you've built up more experience, then you may want to start looking more at individual stocks, and you may want to decide the stocks that you want to invest in. But I suggest that you do that after you've maybe gained some experience in investing in some funds. Because if you want to invest in stocks, you are going to have to do research on the companies that you consider. Look at whether they have good track records, whether they have good management. Is the price reasonable? Does the stock add diversification to your portfolio, or is it just the same or similar to something that you already hold? So when you start investing in individual stocks, as you build up experience, you're going to have to spend much more time on this step, this research, to ensure you're making informed investment choice. So I think I've given you quite a few things there. I know I've started off with some very, very basic things. Maybe you're doing them already. Maybe you're aware of them already, in which case, great. But if not, then you need to be aware of them. The things that we've talked about, like tracking your spending, making a budget, because that is where your investment is going to come. So we're going to continue with this good investment guide tomorrow. Tomorrow I'm going to come up with some specific investment strategies for you. And then next week in this series of podcasts, we'll take a much closer look at mutual funds and exchange traded funds. But that's probably about as much as I should say for this afternoon, because there's quite a lot of information there. But if you have any questions, feel free to ask me questions.
Yes, Peter. That was a very informative session. I would like to ask one more question with you. That you explained that stocks are very ideal investment tool for beginners, and diversification can reduce the risk. Can you please tell like what are the other methods which can reduce the risk or mitigate the risk for young investors?
Yes, for sure. Well, there's several things. I mean, we'll go into these in more detail in later podcasts, but where does your risk come from? Well, it comes from two places, really. First of all, it comes from the market. It's what we call the beta. If you're exposed to a particular market, then you're going to bear the risk of that market. Now, certain markets are much more riskier than others. If you're investing in an emerging market, for example, in general, the volatility of that market tends to be much higher than, say, a developed market like the United States or Japan. So one of the risks that you're taking comes from the market. So one of the things that you have to look at is that are there times when you need to reduce that market risk or hedge that market risk? And there are various strategies that we can talk about that will help you hedge that market risk if there are certain things that worry you that may be going on that could lead to a lot of volatility. So it could be using the futures markets to hedge your risk, maybe buying put options to hedge the market risk of your portfolio. Now, the whole market isn't going to go to zero, that's for sure. You may see some big moves in the market,
True.
But stocks certainly can go to zero. So if you're exposed to particular stocks, there's no reason why something can't happen to that particular stock and it can go to zero very quickly. And we've seen that happen only in recent weeks, both in developed markets as well as emerging markets. So it's not just a risk there for emerging markets, it's a risk for developed markets as well. It's what we call the alpha, if you like, the performance of individual stocks in your portfolio. So we have to look at, where the risks come from. You also have a currency risk. If you're based in India, then obviously if you're invested only in Indian rupee stocks, then you're not really bearing a currency risk in the sense that it's your home currency. But if you invest in overseas markets, then there is a currency risk. There is an interest rate risk to your investments. If interest rates go up, then you will find that quite often the value of your stocks will go down and the value of your bonds will go down as well. That's something that, of course, we're seeing a lot of at the moment as central banks around the world raise interest rates. So you have to manage the risk. You have to break down your portfolio into all the different elements that actually cause that risk. And the risk is basically of you losing money. The key thing is you want to be in the situation where you can't lose in your investment fund all of your money. If you're at risk of doing that, then your investment strategy is completely wrong. Maybe you will lose money and more than you want, but you should never be in a position in your investment fund. I'm not talking about your trading fund, that's different. In your investment fund, you should never be at risk of losing all your money. You should have a fund that at most has a risk tolerance that you can bear. And even if you do lose money one year, you can keep on building over the coming years to make up for that. And if you invest over a long period of time, you can make up for quite big downturns, quite big drawdowns, as we call them, in the market.
Thank you, Peter. That was beautifully explained by you. I think that will be it for this session today. It was fun talking with you, and it was very informative and very resourceful for our young investors. We'll be continuing this discussion in our next episode.
Okay, I'm looking forward to it. So that will be same time tomorrow.
Yeah. Thank you, Peter, once again.
Thank you, Peter.
Thank
Good
you.
talk. Looking forward to tomorrow's.
Thank you very much.